For more on our top line story, we're joined by Diana Avigdor, portfolio manager and head of trading at Barometer Capital. Diana, thanks so much for joining us.
Thanks, Amber.
So let's talk about first the reaction to this news on Friday. As somebody who kind of sits on the trading desk and see how these things unfold, what were you seeing? And I was being told that a lot of this selling pressure was coming from the United States versus the Canadian shareholder base. What was your view?
Definitely surprise. You look and you say, oh no, first of all. Lots of volume and about $7 billion worth of market cap erased right there. But everybody tries to get through the same door at the same time. So there's a bit of selling pressure as you've seen on Friday. Not surprising, not unexpected when you have a notice like this or news like this. But you have to step back at times like this, and from a portfolio management perspective or as a holder, and you have to assess all the pluses and minuses of the situation. I would bring the attention of people to several things. The economy, the steepening yield curve, and when you want to take a financial exposure like we have, you want to diversify. There is several banks, both here and in the United States, that you can invest in, and for a 15% weight or a 25% weight, for example, you can heftily put in quite a few banks.
That's a good point, because a lot of the downgrades just have to do with the fact that, you can find other names elsewhere and you don't necessarily need to give TD the premium that it has typically enjoyed. Is that kind of what goes on in this situation? Is, we know TD, we have always liked it for a U.S. exposure, but given this issue, maybe it shouldn't trade at a premium?
But you know what? Also, from a perspective of a portfolio, and for foreign exposure, you have TD and Royal in a portfolio as a diversifier, and hopefully you can also invest in some of the U.S. banks, which trade on different metrics, cheaper on book value but not as high in dividend yield, and so you sort of diversify your portfolio, and that is truly the name of the game in taking on a sector exposure while diversifying your risk. And so if you did that, then your 3% weight in TD on a portfolio of 20%, which would give you at least 7 banks, let's say, would not hurt you too much. Now, in terms of actual TD trading or outlook, you have to realize that these banks are trading on the prospects of better economy and higher yield curves, period. That is their business. Yes, this could be a big deal. We don't know anything, but sentiment is hard to quantify, so it may hold for a while. But you've seen Wells Fargo, and I heard what you said before, but you see the Wells Fargo longer term chart, and yes, it was at 10%, but it moved on. So the longer term economy and the longer term drivers, and I'm not even talking about 5 years out, let's just talk about 6 months to 1 year out, should be driving your decision, and please diversify.
And Diana, what has sentiment been like around the Canadian banks? We know for so long there's been this base of investors that have been itching to short and just looking for something to give in the Canadian banks because of the exposure to Canada's household debt, and yet every quarter they're able to kind of extract more blood from the stone. Do these kind of events kind of turn the tide and give those arguments more credence?
They do temporarily, but international investors have been notoriously wrong on Canadian banks. Look, we have a 4.5 plus yield support here. We have earnings growth. We have very high ROEs. We have a housing and a mortgage market with a mortgage, insured mortgage and stickiness that does not exist in the U.S. market. We have refinancing risk that is much lower than in the U.S., so stability, let's call it, in the mortgage book. We have energy that has been range bound. Yes, it's sold off lately, and that may come to the forefront. But in a housing market that won't crack, with rates that probably not going up in Canada anyway, in the very near term, not like in the U.S. And as a matter of fact, the de facto rate cut anytime the U.S. actually raises, which they probably will raise a couple of times before we get there, if we get there this year. So there's lots of support. Oh, and less banks with a very captive investor base, because the Canadian equity market is not that diversified and is barbelled by two major sectors plus the rest. So some support.
What would make you concerned? What types of escalation on this specific TD story would make you concerned about holding TD altogether?
The story is not unconcerning to begin with. This is important and could definitely and does definitely put a cloud over the stock. The way we work at Barometer is we will have our levels where we will get stopped out of the stock from a stop loss perspective. That takes the emotion out of holding on to a stock that's not performing. Also, as other things perform better from a portfolio management perspective for our clients, if there is a better place to put the money, even if a stock is flat and everything else is going up, from a relative strength perspective, eventually we will trade out of the stock and move into something that's better performing. What might escalate this? Economic situation generally deteriorates. News come out in time that this is a bigger problem from a corporate governance perspective, for example, that might put a cloud over the stock. U.S. exposure, economic situation in the U.S. that, say, is not playing out to the growth impact that people are expecting, and so forth. So those are some of the things. For now, do you buy it? Not sure. You probably can afford to wait a little bit. I know that some people are definitely trying to pick bottoms for a trade. As you see today, the volume is pretty high.
All right, Diana, thanks so much for joining us.
Thanks, Amber.
Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management.